Hello everyone, I am Rongying from ChinaAMC. Welcome to the ChinaAMC DeepTalk video podcast. If we had to choose one asset over the past few months that has been the hardest for people to understand, gold would definitely rank first. In theory, with geopolitical conflicts happening so frequently, everyone is looking for a safe haven. Gold should be surging. But in reality, along with the news of escalating conflicts, gold prices instead showed some unexpected volatility and declines. So many people have been asking whether this traditional safe haven myth has stopped working. So today, we have invited two old friends to help us analyze this issue together. One is someone everyone knows very well, macroeconomist Pan Xiangdong.
Hello everyone, I am Pan Xiangdong. It is a great honor to discuss gold with all of you today.
The other is a specially invited distinguished guest, Senior Manager of Investment, China at the World Gold Council, Yu Mingming.
Hello everyone, I am Yu Mingming from the World Gold Council.
Welcome to both of you. Today, I especially want to talk with you both about what is behind this roller coaster in gold prices, what the real logic is, and for ordinary investors like us, how exactly we should position our gold holdings right now. Should we panic and cut our losses, or patiently invest on a regular basis, or take this chance to increase our allocation? First of all, when facing this round of gold prices, falling from the highs like a roller coaster, it is only natural that people feel anxious. One investor told me that he bought gold when it was at $5,200, and now he is down nearly 20%. The first thing he does every morning when he opens his eyes is check the gold price. And the first thing he does before going to sleep is check the gold price again. He lives every day in this state of panic and anxiety. After hearing that, my first reaction actually was not to immediately explain to him the investment logic of gold. Instead, I thought his position size had already exceeded his psychological tolerance. What I consider an appropriate position should be this: if it rises, you will not feel that you bought too little. And if it falls, you will feel relieved that you did not buy too much. That is roughly what a suitable position looks like. This is one of my deeper reflections on gold investing. In essence, what you are managing is not your gold investment return, but your own emotional capacity. So I would like to ask our two guests first. Among the investors you have come across, what kinds of gold investment anxieties like this do you hear most often?
In my experience, there are usually two situations that come up most often. The first is when gold rises very quickly. When gold surged rapidly in January, investors were very anxious. They worried that they had missed this rally. So it was easy for people to get carried away and start chasing the price. And once they started chasing, the moment a sharp drop came, they panicked again and became anxious again. Because think about it, if it drops from over 5,000 to over 4,000, that is 20 to 30%. And most ordinary investors cannot handle that. They are taking gold, which is originally an anchor in medium to long-term asset allocation, and treating it like a short-term speculative stock. I would not necessarily call it an asset mismatch. But if someone operates like that, they are definitely going to feel anxious. But if you take a longer view, look at December, January, February, and March. If you smooth out those 4 months, it actually moved quite steadily. So my suggestion is that investors really do not need to be anxious, because when you invest in gold, it is meant to be a medium to long-term anchor, not a short-term speculative instrument. So if your starting point is wrong, you will naturally feel anxious.
All right. Thank you, Mr. Pan.
Actually, I want to extend the time horizon a bit further. Back to 10 years ago, to 2016. At that time, the United States was in the middle of a presidential election. I had just joined the World Gold Council. Then in November, I posted my first social media update about gold. I said, have you all stocked up on gold yet? The global drama is just beginning, and it is okay if you have not yet. The first person to like that post was Mr. Rongying. At that time, Mr. Rong had probably not yet become an investment manager. I want everyone to look at what people were thinking when gold was at 280, what their mindset was like at the time. Let me read a few of those comments for everyone. The first one said, I am already in and waiting for 290. That is a very typical case of chasing gains and selling in panic, right? A 3% return is enough for me. The second one said, I bought too little and now I am full of regret. That is a kind of fear of missing out, right? The third one said, it is already this high. Should we still buy? At 280, people were already afraid of the high price. The fourth one said, maybe this is a chance for a limit down move, which is also a form of fear of heights. The fifth one said, the bull market is over. The sixth one was the most interesting. It said, I bought at last year's high and I'm still waiting to break even. I found that one especially interesting because it came from a former colleague of mine. Then, a little more than 3 years later, in 2020, I tagged him under that post and asked, are you out of the trap now? He said, I sold as soon as I broke even. And then a few days ago, I bought again at a high point, and now I'm trapped again. You will notice that even at 280, people were already afraid of the high price. This anxious mindset does not really change because of the price of gold. It has always been there.
Because as a fund manager myself, I also look at market data every day. But frankly speaking, the way gold has moved over the past 2 years has been shocking even to me. At the beginning, the daily fluctuation in gold was indeed quite limited. So I felt that managing this product did not seem to involve much to do. But after 2024 and 2025, that was no longer the case. It turned into a market that surged in a straight line by more than 50%. Behind that was the accumulation of global uncertainty, together with expectations of looser liquidity and structural buying by central banks. We have also seen many investors move from watching on the sidelines to feeling they must allocate at least a little. The timing of that psychological shift may differ from person to person, but the mental journey is basically the same. So let me ask the two of you, or the people around you, at what moment did that shift happen?
I think for some people around me, it happened around last September or October when gold was at 800 and pushing toward 900 and 1,000. At first, people were thinking I will wait for a pullback and then buy. But gold kept rising and never really gave people a good opportunity to buy after a pullback. At the same time, people did not want to miss such an opportunity. So they shifted from waiting for a pullback to gradually starting regular investment. And I think that strategy is actually very sensible. Why? For example, now that gold has fallen by 20%, you may originally have planned to add more on a pullback, but now your fear may take over. But if you had chosen to start investing regularly from that point, even if you had started at 800, you would still have some unrealized gains now, and your mindset would be much steadier.
Actually, some of the people I have spoken with really only started paying close attention to gold in 2025. Because those friends of mine found that when allocating assets globally, it was genuinely difficult to allocate well in 2024 and 2025, especially if they had bought medium to long-term 30-year US treasuries, which fell so badly, and US stocks were no longer making money either. As for domestic real estate, property in Beijing, Shanghai, and Shenzhen had also declined over the years. By contrast, he said that from 2023 to 2025, gold, think about it, in 2023, London gold was under 2,000 US dollars per ounce, suddenly climbed above 4,000 and 5,000, and he said it had already doubled. Once people compared assets, the feeling of regret became especially strong. So they started asking many more questions, and that is usually how it goes. Because people usually pay much more attention to assets when they are rising. When they are sitting low or rising slowly, people actually do not pay that much attention.
So perhaps we could say that many people notice gold as an asset when its performance compared with most other major asset classes began to show a very obvious divergence. After entering 2025, most assets saw their return gap versus gold widen more and more. And that was when this asset class started to stand out particularly clearly.
Yes, before the Federal Reserve had started cutting rates, the yield on a US dollar money market fund at that time could exceed 5%, which I thought was pretty good. But later, when people saw gold rise so much and rates begin to fall, this contrast effect really started to show.
And for quite a long time, it really was the case that there was strong enthusiasm for gold everywhere. I remember very clearly that in 2021, there was a large shopping mall near my home, and on the top floor, there was a very interesting themed display area. In 2021, that display area was completely occupied by various new energy vehicle brands. Then, when I went back in 2022, I found that all the displays had changed. The original displays had been removed and replaced with gold. At the time, I even wondered how long this could last, but it lasted much longer than I had expected. There is even a joke online now that in these gold shops, when the sales assistant is pitching to you, she does not talk about the craftsmanship. She talks about the collapse of dollar credibility and the broader macro situation. When this public consensus appeared, I actually felt a jolt in my heart. Because when this kind of broad public consensus gathers around the idea of collapsing dollar credibility, it is often when the bubble is at its most intensified and fully developed stage. At the very least, it marks a relative peak in market-wide investment enthusiasm at that stage. We saw something very similar in our 2015 stock market, where the same kind of phenomenon appeared. But at the same time, I was also wondering whether this time might be different. Because gold is not like an individual stock, right? For a stock, the size and capacity of a market are limited, so short-term speculative money can also exit very quickly. Gold is a very large major asset class. Behind it, there may be an investment logic that lasts for 10 or even 20 years. And once money exits gold, where else can it really go? So I would also like to ask both of you what you think about this question. When you hear the phrase public consensus, do you feel reassured or do you feel a little uneasy?
Gold is a global asset. It is actually different from some of our domestic assets. When our market is very hot and fund subscriptions increase, people may then become more risk aware. But with gold, it is not only us who are paying attention. The whole world is watching. And just because we are watching it does not mean everyone else in the world is paying close attention too. From what I understand, Chinese people have a relatively strong desire for wealth on a global scale and are also very sensitive to it. That sensitivity is strong. And you will notice when you go to Beijing, Shanghai, and Shenzhen, people all have a strong interest in global major commodities and in all these kinds of assets. And the level of professional understanding and enthusiasm is actually not something you see as strongly when you look across the rest of the world. So when we choose our sample, the conclusions we get from our conversations may not represent the results of a broad global sample. Overall speaking, for any asset, if it rises too quickly in the short term, you need to be cautious. But for ordinary people, what matters is the trend rather than the short term. So do not care too much about short-term fluctuations. Instead, be clear about the logic behind your medium to long-term allocation, or simply think clearly about your original intention.
I actually agree very much with one point Mr. Pan made. First, you just mentioned that what each person sees is actually very different. Another point is what was just mentioned about the collapse of dollar credibility. I think that statement is actually a bit exaggerated. I think that if you ask an American or even ask a British person, as Mr. Pan said just now, their understanding is different. They do not feel that dollar credibility has collapsed, right? But people have also seen that after the Russia-Ukraine conflict, many central banks, institutions, and individuals started to separate a portion of money from the US dollar and allocate it to gold as part of diversification or de-dollarization. That is indeed happening because everyone sees things differently. Second, regarding the gold shop sales assistant that was just mentioned, when she talks about the collapse of dollar credibility, I actually think that under the current broad trend of deglobalization, the world has become too complicated. Many individual investors and institutional investors really have no way to precisely grasp the rhythm of these changes or their specific developments. But I think this somewhat blunt and simplified way used by the sales assistant to sum up all these global changes as the collapse of dollar credibility actually does capture one main theme of current global change, right? For ordinary investors, it is actually very difficult to follow all of these highly specialized things. But what we can focus on is the main line, right? The key contradiction. So I would say that in a world that has become especially complicated, our investment decisions are actually better the simpler they are.
I believe that for many people, at the moment they got into gold, they already had some mental expectation about a pullback after gold had risen too much. At the moment they bought, I believe they were prepared to take losses and yet felt they had no choice but to buy. But honestly, when the international gold price really broke through 5,600, right, and then corrected 20% in just 2 days, people were still shocked by how powerful it actually was when it came. So when you saw the market screen, what was the real inner monologue for the two of you? Did you have that feeling that the sky was falling?
Actually, I felt very calm inside. One reason is that I hold physical gold. So I simply cannot really see exactly how much I lost after it fell 20%. Out of sight, out of mind. Second, I have been with the World Gold Council for 10 years. I bought this gold when it was in the 200s or 300s. Because I have held it for a very long time, my gains are already quite high. So even if it drops 20%, I do not really feel it. Third, I plan to keep holding it. So whether gold doubles again or falls another 30%, it actually does not affect me that much. I have already made up my mind to hold it for the long term.
Actually, it was not when it fell that I thought it was unusual. It was during that sharp run up before the drop that it started to feel a bit abnormal. Originally, it is something very stable. In the history of gold, its rises and falls have generally not shown especially large volatility. That is why people treat it as a safe haven, because it usually moves in a steady way. But in December and January, when it was surging sharply upward, that was actually when I started to feel a little worried, especially since silver moved with it and was also surging sharply. Sometimes even our stocks were not rising that much. So when a decline happened, it did not feel all that surprising because things that rise too fast also fall fast. That is simply how it works. It shows that speculative money had already entered the market. A lot of it was leverage capital, and leverage capital pushes prices up quickly when it comes in and leaves quickly when prices fall. So again, it did not feel especially surprising. But when it falls, one thing you need to think about is whether, if you have some spare cash, the drop might be giving you a chance to enter. Because after all, when investing in gold, the focus is on the medium to long term.
Indeed, when I myself saw this market movement, I was not particularly surprised. Because even before the drop, people had already noticed that across various gold derivatives, the implied volatility shown in gold trading had already reached a historical extreme. At that time, on the CBOE Chicago Board Options Exchange, it had probably reached 40. At that level of volatility, a correction of this magnitude was, in my view, completely normal. But what I was actually thinking inside was that it really gave everyone time, not necessarily to buy more right at that moment, but time to finally pause and seriously think about when exactly I should invest in gold and whether under this opportunity I should buy. I also very much agree with the point Mr. Pan made just now that patience is always the biggest hurdle in gold investing. So before recording this episode, we also collected online some of the biggest questions people have about gold. One of the most frequently raised questions was why, when geopolitical conflict in the Middle East escalated and oil prices surged, which should have been a safe haven moment for gold, gold prices on the first day of the war opened higher briefly and then gradually weakened. Why did the traditional logic people talk about, that gold is what you buy in troubled times, suddenly stop working this time? I think what people are really asking is what exactly is the core pricing logic of gold trading and which factors most affect the rise and fall of gold prices.
I think if we want to discuss why gold seemed to fail as a safe haven this time, we first need to clarify where the most fundamental reason for gold's safe haven role actually comes from. I think there are really two reasons. The first is that gold is extremely scarce. Its scarcity is cosmic in scale. I want to first explain where gold actually comes from. First, you need a star about 8 to 10 times larger than our Sun. Then, inside that star, there is nuclear fusion. When the energy from that fusion is no longer enough because the star has an enormous mass, it collapses inward. After collapsing inward, it explodes. That explosion is what we call a supernova, and at that point, a neutron star forms. So what is a neutron star? A neutron star is the second densest object in the universe. The densest object in the universe is a black hole. So where does gold come from? You need two neutron stars, and those two neutron stars collide in the universe, and gold is produced during that collision process. Then that gold arrives on the early surface of the newly formed Earth through meteorites. So just think about it. Across time and space, this is an incredibly precise coincidence. It is much harder than finding a partner and completely different from elements like hydrogen, helium, carbon, and silicon. Completely different. And if we want to put it more romantically, it is really a gift from the stars. That explains the scarcity of gold. But think about global M2, broad money supply. It may be growing by around 8% each year. That is the core logic behind why gold can resist currency depreciation. Its scarcity is the key. Many people pay attention to large rises and falls in asset prices. But the risk of this kind of gradual currency depreciation can sometimes be greater than the risk of asset volatility. The second point is that I think the most important thing about gold is that it has no sovereign credit risk. As I said just now, gold comes from outer space, right? A recent example is 2022. After the Russia-Ukraine conflict, people saw that Europe and the United States began sanctioning Russia's central bank and sanctioning Russian individuals. But if what you are holding at that time is gold, and you keep it in your own home or in your country's vault, it actually has no counterparty risk, right? So after the Russia-Ukraine conflict, people could see that central banks had originally been buying around 500 to 600 tons of gold a year. But starting in 2022, that figure suddenly reached around 1,000 tons. This perfectly demonstrates that gold has no counterparty risk, which is one of its core safe haven qualities. So this time, all we can say about gold's decline is that this long-term logic was not reflected in this short-term move. It does not mean that gold has lost its safe haven properties.
Exactly. And then people suddenly feel that even this safe haven asset needs a safe haven of its own. In fact, it is not that its safe haven nature has changed. It is that your understanding has changed. And the reason your understanding changed is that you turned a medium to long-term issue into a short-term one. Let me first talk about history, and then you will understand, and then I will explain the reasons. When the financial crisis happened in 2008, people thought gold should be used as a safe haven, right? But people saw that at the beginning of the financial crisis, gold actually fell. But once the crisis fully erupted and people calmed down, gold climbed rapidly. Then, when the Russia-Ukraine conflict broke out in 2022, global risk shot up sharply. Everyone knows there is a fear index, and when that fear index surged sharply upward, gold also fell. Then after the fall, once things gradually eased, gold rose rapidly again. Have you noticed that when an extreme event occurs, gold often falls at the beginning? So why does it fall? Take this Middle East war as an example. Why did gold fall? I will analyze it from 4 dimensions. The first dimension is also the most central one. When the Middle East war breaks out, the first thing people see is oil prices shooting upward rapidly. What do people immediately think of? inflation is coming. And then, what is the second association? The Federal Reserve is going to raise interest rates. So once oil prices rise, the dollar index climbs because people think rate hikes are coming. And what is gold's natural enemy? High interest rates and high inflation. Everyone still remembers what happened after 1980, right? How badly gold fell. At that time, when inflation became a problem, the Fed chair Volcker chose aggressive rate hikes. So when the Middle East war begins and pushes oil prices higher, people immediately think, is this the time to sell gold? After all, gold is a zero-yield asset. If high inflation appears elsewhere and aggressive rate hikes are expected, wouldn't people naturally move into yield-bearing assets? Then the second aspect is, think about it. During a war, where is it happening? It is happening in the Middle East. Everyone knows there are many wealthy people in the Middle East. People casually used to say Middle Eastern princes, right? But once war breaks out for these wealthy people, what matters more, wealth or life? Of course, life matters more. They will convert the assets in their hands into more liquid cash and then leave that dangerous place. And what people have seen recently is that physical gold in Dubai has been selling at a discount. This shows that these wealthy people are selling physical gold and choosing cash with better liquidity and preparing to leave. That is the second reason. Then the third reason is everyone knows the Middle East is very wealthy. Once war breaks out in the Middle East, especially if the Strait of Hormuz is blocked, their money printing machine, oil can no longer be sold, and their oil production equipment and oil fields may even be bombed. But those countries are very rich, and being rich means public welfare benefits are very high. But those countries do not have much industrial production. So what supports such a high standard of living? It is oil extraction. One of their income sources has been disrupted, but those high welfare obligations are still there. People still need to eat and live. Civil servants still need to be paid. All of this still has to be maintained. So what do they do to maintain it? Then their governments can only rely on fiscal resources and sell off their foreign exchange reserves to keep the system running. And what is in those foreign exchange reserves? That would be dollars, US stocks and US bonds, and also gold. If they sell US stocks and US bonds, people find that they are still taking losses and did not earn much. Gold has made good profits and its market is large with very strong liquidity. So at this time, they may sell part of their gold for fiscal needs. Think about how large the foreign exchange reserves of sovereign states are. If they sell, the market impact would be huge. At the same time, some countries' currencies have experienced major volatility, and Turkey is a typical example. Its lira depreciated very sharply. So what does it do? So Turkey's central bank decided to sell gold to maintain exchange rate stability. If you say Turkey's central bank sold gold, does that mean it is bearish on gold? No. Last year, Turkey's central bank had been increasing its gold holdings, and apart from our country, Turkey was one of the countries with the biggest increase. But in this special period, there was no other choice to maintain exchange rate stability. It had to sell this gold to keep things stable. Think about it. When an exchange rate faces major volatility, what it turns to for support is gold. Do you think that means it believes in gold? Of course it does. This is its ultimate backstop asset, right? Then there is a fourth dimension. When gold had been rising rapidly before, a great deal of speculative money and leverage money had entered this. When these three forces started to move downward, the capital that amplifies both rises and falls would also choose to leave. So people saw that in this unusual period, gold fell. In other words, these four forces caused the short-term downward move.
That is an extremely deep and comprehensive analysis. Actually, from my own perspective as a gold investor, I have probably been deeply misled by three handed-down sayings. The first handed-down saying is, buy gold in troubled times. The second is, the relative price method. looking at the gold-oil ratio and the gold-silver ratio, right? And the third is that gold and US dollar real interest rates are basically the same thing. So when it comes to these kinds of expressions and the way they affect people's thinking, I think there is a risk of over-anchoring people's understanding. And I do want to give some warning about that. As I understand it, gold, what kind of risk is it actually hedging against? I think there are three layers. The first layer should be some short-term emotional risk caused by sudden unexpected events. This kind of risk usually involves events that are themselves very complex and can easily be suppressed by other factors. Also, the market may very well have priced it in earlier. By the time the actual sudden event occurs, the emotional trading may already be over. The second type of risk, as I understand it, may be risk related to inflation. Actually, it is not exactly inflation risk. It is really the risk of declining purchasing power of money. The third layer of risk is deeper. It is the risk of a crisis in monetary credibility. So actually, in the framework of this latest gold move, I think the first type of risk had actually already been priced in earlier. In fact, by mid-February, we already knew that the US aircraft carrier Ford, which should have been in the Caribbean region, had already started heading towards the Middle East. So in fact, gold prices had already reflected some of that safe haven and event-driven emotional trading demand before this. Second, going back to the purchasing power issue we just discussed, if we look back at gold's 2025 market performance, when did it accelerate again? It should have been in August 2025, after the Jackson Hole meeting. At that time, the Fed's remarks made people feel they might become more tolerant regarding the unemployment indicator, and that opened a window for rate cuts. From that day onward, it was not only gold, but also a weakening of the dollar, represented by the US dollar itself. And that was accompanied by gold and precious metals. And later, the market even began pricing into all kinds of assets that stand on the opposite side of the dollar, a broad and abrupt rise in commodity prices. And that trading trend continued until January this year. In addition, the liquidity framework we just mentioned is also very important. It really is true. For example, if you look at Turkey, right? Even the wealth funds of a sovereign country like that face liquidity risk and need to raise cash. And raising cash does not only mean selling gold. Last week, it seemed people found out that 20 tons had been sold and another 31 tons were handled through swaps. Those swaps may not have been outright sales. It is more like, I lend it to you first and raise some financing first, and later I take it back. So throughout this whole process, it really was the case that its financial pricing characteristic, in my view, began to dominate. And the kind of risk gold can hedge against has never been liquidity risk. In other words, gold pricing has never followed a single logic. It is the result of different dominant factors working together across different periods. So as we just said, this sharp drop was not a structural failure of gold's safe haven properties. It was suppressed by this short-term stagflation trade. If it is a short-term suppression, then later on, it may instead become an allocation window. Personally, I may lean more towards the latter view, namely that short-term liquidity shocks and disturbances in interest rate expectations cannot change those longer-term structural forces. So I would also like to ask Ms. Yu, from the perspective of the World Gold Council, what kind of mechanism led gold to show the seeming failure of its safe haven property?
I think the summary has already been very accurate. The first point that most people recognize is that high oil prices affect inflation and then affect interest rates, which creates expectations of policy tightening. I think both of you have already mentioned that. The second is profit taking, exiting the market, and deleveraging. Because from 2025 to 2026, gold rose sharply. many retail investors, speculators, and leveraged traders actually flooded into the market. One of the clearest examples is the New York Mercantile Exchange, where the proportion of mini futures contracts rose rapidly. When volatility is this high, this kind of speculative capital exits very quickly, and that accelerated gold's decline. The last point is liquidity. But liquidity needs to be distinguished a bit. Liquidity can be divided into a liquidity crisis and liquidity preference. I think this decline was more about a preference for liquidity, because, for example, interest rates rose, US stock valuations were relatively high, and gold volatility was relatively large, so people chose cash. But this time, there was no real liquidity crisis. That was true in both China and the United States. China's repo rates did not rise very much, and money market funds did not see large inflows, right? And in the United States, interbank lending rates still remained below the Federal Reserve's target rate. So the market did not have a liquidity crisis. I think this still needs to be distinguished clearly.
I also find that very interesting. What we were talking about just now may in some cases be from the perspective of financial pricing theory. If I were really an actual market trader, as a trader, would real interest rates really affect his personal life or his direct feeling about using gold? No. But he may think the whole market sees it that way, so I also need to sell. Maybe only a small number of people at the root of it really have that shift in preference, and then they drive others into the same kind of trades. But what exceeded my expectations this time was that in February, various gold exchanges, both domestic and overseas, adjusted their margin requirements. For example, domestic T plus D margin ratios went up to 40 or 50%, right when trading volume had already shrunk sharply. What we saw in February was central banks entering the market, still willing to keep buying gold at high prices. I had actually thought that under those conditions, speculative positions had mostly been squeezed out. I did not expect that in March, there would still be so much speculative money still following the trend in this market and still selling. I also want to ask Mr. Pan how he feels about this. The market's expectation for Federal Reserve rate cuts has dropped sharply, from 3 cuts at the beginning of the year to almost 0 now. So how much does that affect the holding cost of gold?
It will have a short-term effect because, after all, gold is a zero-yield asset. When the dollar enters a rate hike phase, the interest income people earn increases. First, if the Middle East war continues like this, the longer it lasts, the longer oil prices will stay at high levels. Then, US prices will be transmitted from PPI, Producer Price Index, to CPI, Consumer Price Index. Then the question the Federal Reserve will be discussing is not rate cuts, it will definitely be rate hikes. That will still have an effect on gold. There's a seesaw effect. But personally, I think these should still be short-term factors. The more important issue that follows is US Treasury debt. Because with such a massive amount of US debt, if the 10-year Treasury yield rises, the question is whether the fiscal system can bear it. In the fourth quarter of last year, US GDP growth was actually slowing. If GDP growth goes down while your CPI, Consumer Price Index, or inflation level keeps rising, then fiscal pressure will start to appear. People should not underestimate this risk. Why do I say that? When I talk with many investors, they all think the United States is fine right now, nothing like it was before 2008. Because in 2008, people saw that household leverage and corporate leverage in the United States were very high. In other words, debt levels were very high, which is why the 2008 financial crisis happened. But when people look now, household leverage and corporate leverage in the United States are not high. They say, what crisis could there be? But people have not thought about the government. Right from 2008 until now, there has been a transfer of debt. And where was it transferred? Government leverage rose sharply. That is to say, through government borrowing, the debt of households and companies was replaced. So if a crisis occurs, it will be completely different from 2008. When the crisis happened in 2008, when companies were in crisis, the Federal Reserve and the government could still step in to rescue them. But if government bonds run into trouble, who is going to rescue them? So people should not underestimate this. So one question we should think about is this. This has only disturbed gold prices in the short term. it does not mean your medium to long-term allocation logic has gone wrong. Have people thought about this? What is the core logic behind this round of gold gains? In the past, we explained gold rising through the dollar index because people thought the dollar index and gold had a seesaw relationship. And from the perspective of historical data, I work in quantitative analysis and we have also done fitted regressions. Historically, 60% of gold price moves can be explained by the dollar index. But from last year onward, the dollar index has just been fluctuating between 95 and 100, while gold prices have been rising rapidly. So you cannot explain this round of gains with the dollar index. It just does not work. Second, people say Federal Reserve rate hikes or rate cuts will affect gold prices. But have people thought about when the real acceleration in gold prices happened? It was after 2022. Was it really that sensitive to interest rates? So using Federal Reserve rate hikes and cuts still cannot explain this round of gold gains. Some people also ask whether there may be geopolitical reasons or reasons related to geopolitical conflict. Think about last year, when in Las Vegas, there was the real beginning of peace negotiations over the Russia-Ukraine conflict. And then this new round of geopolitical conflict appeared. Did you find that gold prices were meaningfully explained by that? When there was hope for peace, gold was also rising. And when this round of conflict intensified, gold was also falling. That shows geopolitical conflict also cannot explain this round of gold gains. Actually, this round of gold gains has an underlying logic that is different from previous rounds of gold gains. The round of gold gains in the 1970s can be explained through real interest rates. In that round, gold rose 22 times. The second round was actually the rise in the 1990s, which can be explained by abundant liquidity. That is, the process of continuous monetary easing by the Federal Reserve, and at the same time, the collapse of the internet bubble left people with few assets to choose from. After thinking it through, and in the end, they chose gold again. In that round, gold rose about 8 to 10 times. But this round of gold gains cannot be explained by either of those previous two logics. Actually, the core logic of this round has just two parts. First, people are guarding against the risk of de-dollarization. Second, global investors are guarding against the risk of Federal Reserve loss of credibility or virtue. And it is precisely the overlap of these two risks that led global investors to begin chasing gold.